Good day. This is Seiko Radio, and today, part two of financial investment, talking about finances. Our guest is the great Greg PACITTI, who is expert in financial investment and certified financial advisor. Greg, do you mind taking a minute introducing yourself again? Some people didn't didn't listen to the first part. Uh, let's introduce you to the general public, please.
Sure, and definitely listen to that first part because very important. Right before we get into investing is the planning part. And my name is Gregg PACITTI, and I'm a certified financial planner in Sarasota, Florida, and I'm president of a wealth management firm called Ranch Capital Advisors, and I've been in the business over 20 years now.
Good. Now Greg has been in the business for 20 years. Greg, the first part of this show, we talk about the planning. Now, after
Mhm.
planning investing, someone who wants to invest, what is the first step? Risk and reward. Some people want to invest, and some people want to invest. To want to be conservative. So, as a coach and advisor, what's your opinion?
Yeah, and as we talked about in part one, like a great place to start, or if you're not already, is if your company has a 401k. And with a 401k, each plan has different options to choose from. And most of the time, they're mutual funds or they're exchange traded funds. And they'll have an array of choices where you can be in funds that are primarily invested in stocks or all the way to bonds to most of the time they'll have a stable value fund. And it is a risk reward thing that you need to evaluate really for yourself. And so what I always tell clients about risk is it's not as much about the risk as if the stock market at some point would go down, because what I can guarantee you is that the stock market will go down at certain times. Now the good news is that it's always recovered every time the stock market has gone down. Now it may recover in a month, it may recover in a year or even 2 years, but it always has recovered. And so risk has a lot to do with how are you going to react when the stock market does pull back. If you're somebody that would sell and at the wrong time most of the time, right? Then you really want to limit how much you have in stocks and work with a more stable type of investment strategy, which could even just be a stable value fund, which you're not going to make a lot of money, but typically they're between 1% and 2% interest, but your money is safe. And if that's the right call for you, then so be it. And you'll do better that way than if you would invest in stocks, which can make double-digit returns, but it can also have periods of time where it could lose double-digit returns. And I always say that it's just a temporary pullback, because everyone has like I said, every stock market has been a temporary pullback. But if you're one that would sell, then you probably would do better just in a 1% to 2% interest, because that's the fear is one of the most costly expenses that investors have, and so you have to know yourself, and also definitely getting a better understanding of the stock market or bond market. So if you want to go into what are stocks, whether you're buying stocks outright, whether you're buying them through a mutual fund, stock is just ownership of a business. And so the more you can really look at it as you're a business owner, then the day-to-day fluctuations don't mean as much. So like if I know I'm an owner of Apple stock, for example, Just because Apple may pull back, the stock price might pull back, doesn't mean that Apple is going out of business. And so the more you can look at investing as a business owner versus just ticker symbols, right? It's, a lot of people will just trade in and out, and they think less of the business itself, the harder that is to be successful at it. So I've always thought that the more you can think of it, of investing in stocks as a business owner, the better off you'll be, and it gives you more confidence to ride out it's easy when the market's going up, but when the markets start going through some normal pullbacks like every business cycle does, then it gets it gets a little bit more difficult to hang on. But the more you think of it as a business, it gives you a little bit more confidence to do that. So you have to determine, do I want to be a business owner, or do I want to lend money to businesses? And that's where bonds come in, Sekou. So a bond is really just you're lending a company money for a fixed interest rate. And if you're more comfortable being a lender than a business owner, then the more bonds are appropriate for you. But again, it's going to be a risk reward, right? Where bonds may do 3 or 4%. Stocks historically have done much more than that. But it's just a much less straight line, on your returns.
Now, when you hear the term diversifying your portfolio, can you school us about that?
Yeah, the diversification is a great idea for most people, unless you're a hedge fund that's investing in 6 or 8 companies. Although you could have a diversified portfolio of 10 different companies, or you could have a portfolio of 10 different funds that each own 500 companies. So, but it is important to just as if I said to you, hey, we're going to invest in this laundromat down the street, and you were going to invest all your money in one laundromat. We really wouldn't do that unless that was your own business, right? So when you're passively investing and you don't have any control of that laundromat, it's better to invest in various businesses that you're spreading around your capital into. And you may have businesses that are laundromats, you may have restaurants, you may have gas stations. Is spreading it around, so that is a great way to reduce risk. The idea, though, is to be in businesses that you think over the long term will be profitable and that you want to own for the long term. But it is key to not just have all your eggs in one basket, because what if for whatever reason that something goes awry with that company, right? And so a lot of people who have their own company stock, that you can do really well in it because you have a concentrated list, or concentrated position, but you can also get hurt really bad if things change, and that is out of your control. So we're big proponents of diversification, and nothing wrong with over investing in certain companies that you like for the long term, but also make sure that you have your money spread out, because you always have to plan for the unexpected, and that's what diversification will help with.
Right. Now, for people who don't know much about financial terms, and is there any way you can make a difference? Because investing in stock, the world of stock, and investing in a bond, the world of bonds, is there any way you can elaborate on the difference between those two again?
Sure. Yeah, I would, in the simplest form, it's whether you want to be a owner of a company. See, all the stock market is, it's an exchange that allows you to access really some of the best businesses in the world and become part owner in, right? It's a free market that you can get in if you need to get your money out. It's very different than, like my example of buying that laundromat, where if you invested it, you wouldn't be able to get out your money out as quickly, right? as with the stock market, because the stock market is always and the bond market, you always have a buyer and a seller. And so when you're buying shares, you're buying it from somebody else. So when you're selling shares, you're selling it from somebody else. So the question is, do I want to be a business owner, or do I want to lend money to businesses? And that's the real difference of stocks and bonds, is that stocks, you're buying shares of ownership, and bonds, you are buying shares of a loan. Essentially, you're lending money to the corporation, and they're going to pay you back in the form of interest. And so every bond has a certain term to it. It may be a loan that's 3 years, 5 years, 10 years, even 20 years. And the longer the term of that bond, the higher the interest rate should be. Also, with bonds, it's the creditworthiness of the company you're lending money to. If there's a risk of them going out of business soon, then the interest rate will be higher, but you have a risk of not getting paid back. Where you have other businesses that are AAA rated, that they're established companies with lots of cash, they'll borrow money but they'll pay you a very low rate in return. Now with stocks, I'm buying ownership, and there's two ways that I can make money in stocks. I can sell my shares at a later date to somebody else. So if I bought it for $50 and I was able to sell my shares at $100 later, I have to be able to sell that to somebody else. There has to be another, someone who's buying it that thinks it's going to even go higher. So that's buying low and selling high. I never have to sell if I don't want to. I could hold on to a company and theoretically hold on to it forever, and even pass it down to my kids if I wanted to, if I just want to continue owning that particular company. But if I ever want to really, pull cash out, I would have to sell some or all of my shares. Now, the other way to make money in stocks, though, which we're very big proponents of, is investing in companies that pay dividends. So a dividend is a cash payment that a company will pay to their shareholders, and it's a percentage. A lot of times it's just a percentage of their profits. So think of my laundromat example. If I invested in a laundromat, it made money, and the value of the laundromat will fluctuate, but after they paid all their employees, there's money left over, and they distributed a cash dividend to their shareholders. So stocks work that same way that are publicly traded, is that each company pays, not every company, but many companies can pay a dividend to their shareholders, and that dividend really has no bearing on what the stock price is. The stock price can go up and down, but dividends are declared by their board of directors, and they'll say, well, if you own one share, you're going to get X amount of dividends. And so a lot of times companies will pay these dividends on a consistent basis. There are companies called dividend aristocrats that have not only paid dividends for over 25 years, but they've raised that dividend payment every year for the last 25 years. Those are some of the best, in my view, companies to invest in for the long term, because you're not only going to invest for your stock price to go higher, but now you also receiving cash dividends that you can either live off of if you are retired, or you can reinvest those cash dividends and buy more shares if you're still working towards financial freedom. Where a bond, really, most of the time you're only going to make money on the interest that coupon, that interest that you're lending the company. So if that's 3%, 4%, the good part is it's pretty. You can feel pretty confident as long as the company is in business at the end of the term of your bond that you'll get your 3 to 4%. But there's no appreciation. With dividend stocks, you can get appreciation and also get some income out of it. So we actually really prefer that method. But again, if you're risk adverse and you wouldn't be able to go through some ups and downs of the market, know yourself, and there's nothing wrong with that. But you would then really look more towards the bond market or stable value and have something that's more secure.
Good. That's a good